Welcome to the Greater Central Florida Multifamily Investor Group, where we focus on investing where it makes sense. Hello, everyone, and welcome to the Greater Central Florida Multifamily Investors Group meeting, where we focus on investing where it makes sense. I'm your host, Ismael Reyes, and the goal of this show is to meet people that invest in Central Florida and invest in Florida with others. So it's kind of twofold. We get a lot of folks here that aren't from Florida for that very reason, because it's like we talked about at the very beginning here, Florida's hot. All right, well, let's rock and roll here. I'm going to just talk a little bit about what we're here to do today, right? I mean, a lot of times we sort of brush over syndications as if it's something that anybody can do. And while anybody can be part of a syndication, it takes an entire team. And that's what we're here to talk about today is, how to do that. Because one of the first questions that, a passive investor or an active investor should ask before they participate in a syndication is whether the team that is putting this together has the right experience and time and have the right credentials overall to make sure that they do the first critical thing in any investment that an investor should be thinking about. And of course they do, is how are they going to safeguard my money, right? Yes, we all want to make money. We want to double our money. In a lot of cases we do, but first and foremost, how do I trust these people not to lose my money? And so there's something to be learned, whether you're active or not, about syndications. And we're going to have our panel jump in. I'm going to put a framework together during this discussion of what I think are important pieces. And then we're going to have the panel jump in and discuss those parts as it relates to them. And the beautiful thing about this panel, and I'm going to introduce them in a second, is that they've gone through all the steps to get to the point where they have been successful in syndications. A lot, I think all of them started as passive investors and work their way through to now where they're actually actively involved in multiple syndications. So it allows them to be able to provide a perspective that, if you're dealing with, large organizations or, groups that have 300 plus, they're offering 300 plus units, you're not going to have the same perspective where those folks have been, long gone, have they passed through the places where you're trying to get to, or maybe you are at. I know some of you had some experience and are going to be able to provide feedback as well. So I'm excited about that. So the panel will speak at certain points, give their opinion on certain things, agree or disagree with some of my assumptions. And then you all will have an opportunity to join in asking them questions overall about this discussion. So it'll be interesting. It'll be definitely different than something I've done before, where I normally have only one individual speaking. So we're going to roll through that. So the first thing I'm going to do is I'm going to introduce the panel. Let me go ahead and introduce the panel. Sorry about that glitch. Again, you never know when Zoom is going to do what it does, but we're going to go ahead and introduce Kelly first. And Kelly has been a real estate entrepreneur since 2017 and has a portfolio of 409 units valued at over 45 million. She brings over 17 years of corporate experience in strategy, finance, and integration at the Walt Disney Company. I keep asking her to give me tickets, but I guess I don't make the cut yet. So Kelly, welcome. All right. Tim is the CEO of Zana Investments, which has a portfolio of 416 units, and that's Tim Little. And his portfolio is valued at 46.7 million. He previously served as a strategic planner in the military and a change management consultant for the U.S. government. So a lot of experience there, not just on the real estate side, but also on some of these, these huge organizations that really do have very deliberate processes and planning efforts. So I think that'll be a good perspective to have, just like really Kelly and Walt Disney, which I'm sure has a lot of processes as well to run their huge enterprise. Last but not least is Winston Schofield. He is the founding member of Georgiou Group. He's a native New Yorker. I don't know why he put that on there. I know, because because I love my New Yorkers. They come down here all the time, so that's cool. He started his career in real estate in 2003 as an asset manager for the Lowen Group and has a substantial portfolio of 517 units valued at over $48 million. He also had corporate experience and retired from the airline industry, where he was a flight coordinator. And so Winston has the privilege of being able to fly for free. I give him a hard time all the time. He can go anywhere, anytime. It's great. All right, so good to have you guys on here. And so what we'll do now is we'll start what I call, as I mentioned before, sort of the foundation is to talk about this topic. And I'll kind of lay that foundation, provide some assumptions, and then I'll let the team jump in at certain spots and really provide some of that color that I'm hoping that we get. And then again, of course, if there's somebody on that has questions from the group that's listening in, I would rather you hold that towards the end, and you can cover anything. So I would just say, if you want to put it on the chat so we don't forget it, or if you want to sort of write it down, we'll have an opportunity to really touch on a lot of these subjects. So I want to just kind of break it down by pieces as we go, and then really open up the aperture to everybody for questions at the end. So let's start off with the presentation itself. We're here to talk about, again, successful real estate syndication teams. Anybody can be part of a syndication. If you have the money, I think you can. If you're accredited, you can certainly put your money in whatever deal you want. And that's fine. But to be successful, there have to be some other things that are part of that. And we're assuming, of course, that the acquisition itself is a good acquisition, right? So it kind of all starts with there, because if no matter how good your syndication team is, if it's a terrible acquisition, there's not much that you can do about it, right? So you really, that piece does have to happen. But we're going to make the assumption that we've underwritten these things, and we have a very good way to do these, so that we're conservative in our estimates, so that we can actually overachieve and over-provide returns versus the opposite. And we do that on purpose so that we give ourselves that wiggle room. So we assume we do that. But even then, if you have the wrong team, you really could hit some pitfalls, and it can make a good deal not so good. So that's kind of what we want to talk about today. So let's start off with the outline. We want to make sure that everyone has at least a baseline understanding of the structure of these things. And I'm not going to go deep dive on any particular sub entity or somebody has a question about something, we can certainly answer it. But I'm going to kind of keep it at a very top level, kind of, looking down on certain things. We'll just touch on these things, and certainly we can add more if there's a specific question on these. And there are a couple that I think that are nuanced enough for me to highlight, but some of them is obviously a mortgage broker. We kind of know what that is, so we'll touch base on it, but we're not gonna deep dive on any particular one. And so as we talk about that structure, get everyone up to speed on what that kind of looks like on the syndication side, some similarities, some differences to other types of real estate and other investments, but so we'll focus on real estate syndications as kind of the core. And then we're going to talk a little bit about some of the characteristics that distinguish good syndication teams from those that maybe are struggling, and then some of the pitfalls of why they can potentially struggle, so that if you're a new investor, or if you're potentially looking to invest with a group, you have some questions that you can ask that can kind of zero in on some of these things that we see over and over with some of these groups. And so I think that'd be useful. And of course, if you're an active investor, you can certainly apply some of these principles to your investments and to your teams. All right, so first let's talk about the core team. I think the core team, the main thing that we need to understand about the core team, you can talk about people or you can talk about functions. I prefer to talk about functions. And the reason is you don't have to necessarily have the exact same team from one syndication to another. You do have to have the functions covered, and how you cover those functions is a matter of how you organize yourself. As long as you have everyone covering these functions, I would say, as we kind of go into the functions themselves, though, you do want a little bit of overlap. At least I like to have overlap within my organization, so that no one person is the point of failure. No one function can drop if you have somebody that can't participate in a meeting or be part of something that's going on. Because remember, we're talking about operations that can go anywhere from, the shortest could be, a year. Syndications normally go longer than a year, at least a couple of years minimum, unless you really strike gold, and then you can maybe, do it a little bit sooner than that. But let's just say anywhere from over a year to up to 5 to 6 and longer, depending on what type of asset you're going after and what your business plan is. So, over that lifespan, you have to have people that can cover these functions as you go through them. I want to talk a little bit about the difference between general partners and managers, because sometimes these two terms kind of get lumped together, and they're not exactly the same. Every manager is a general partner, but not every general partner is a manager. The managers of these entities are the ones that are making the decisions for how to proceed with the acquisition. They're the ones that are actually deciding. General partners in and of themselves, unless they're part of that manager group, don't have a voting role in it. Now, you can certainly create some organizations that give others a chance to vote on things. And we'll talk about this. We'll talk a lot about transparency all the way through our organizations. But I think there are, certain people that you want that have the experience that can make decisions, but you still want the input of everyone. And I think but there is a distinction there, right? I mean, voting versus input, there's certainly a difference there. Talked about the redundancy. And the last thing is, there are certain things that everyone really should have a handle on. Whether you're an active investor or whether you are a passive investor, you should have a basic understanding of how to underwrite these deals. When somebody throws terms at you and they say 7% cash on cash, you kind of have to know what those things are, right? And, what is total return versus annual, versus cash on cash? Why are some things annual returns? Why are some of them are total returns? So there's some language there that if you just familiarize yourself with underwriting these, and there are a lot of tools out there that'll do it. Obviously, a lot of us that are in this group use Michael Blanc's syndicated deal analyzer tool, but there are other tools, and some tools are better for, let's say, if you're doing waterfall structures without getting any particular structure, but there are certain structures that are a little bit more advanced that you need other tools. But so long as everyone has that basic understanding, I think that's the best. I think, even your passive investors should know what they're getting into. And I love it when I'm giving a presentation on an acquisition that we're trying to raise capital for, and you have, investors that are asking pointed questions. I love that, because it shows that they're putting their effort in. Some of them, maybe a little bit more than others, and that's fine. It depends on how much time you have available, but I think you should have that basic understanding. The other thing that I talk to my group about, and the folks that I work with, is everyone should have at least the majority. I wouldn't say everyone, because there's certain groups within certain general partners that are in for very specific niches. For example, on the slide there, we talk about risk capital. There's some general partners that all they do is they provide a certain amount of money, and it's money that is risked in the sense that if we don't close, they don't get some of that capital back. But for that risk, we're giving them a portion of the general partnership's piece of an acquisition. So there are some general partners that have very niche roles like that, guarantors, balance sheet, or others, but mostly the rest of the team should be able to raise capital. These, raising capital in a syndication is not its own thing. It is for most syndications, let's put it that way, everyone should be raising capital. Nobody should be going around saying, because it's illegal to say, I'm your capital raiser on this deal. No, capital raising in and of itself is not a role. It is a function within a team. And several people within that team, the majority, should be also looking to raise capital. So some people get in trouble when they talk about how I'm a capital raiser. That's fine. That may be your focus, but within that team, there are other things you must do in order for that organization to stay legal. All right. So I think we covered all of these. I guess the four big ones, obviously, sponsors, general partners. We talked about the differences. We talked about, the active versus limited partners a little bit. Obviously, the active investors are the group that are, day in and day out are involved. The limited partners, essentially, in these, they just make sure that they know what they're getting into, right? They know a little bit about the underwriting, they know the deal, and they put their money in and they get returns. That's essentially the piece of it. We give them reporting. They analyze the report, some of them more than others. They ask questions, they reach out. The team has to be available for those questions. I mean, they are the lifeblood of this business. And so that's their role. It's pretty simple. Then you have obviously your property management team. Really the sponsors and general partners are the asset managers, if you will, over the property managers. So we oversee that the property management is doing their job and they're not squandering resources, because you can do your job and also still not have a successful syndication if your expenses are sky high. So there's a lot of things that need to be looked at. And then of course, depending on the type of project you're doing, you may have a capital expenditure or CapEx piece to your deal, which means that you're probably going to need a general contractor or somebody that can manage that piece of the acquisition. A lot of times when we do value add deals, you're essentially renovating a portion of the units, and that is what's driving some of the returns. You're adding value, and therefore you're able to get more rent, maybe even streamline and reduce your expenses, and that provides those returns that we're looking for in those value add deals, which means you do have to have that function. And then certainly the sponsors and general partners act also within their asset management role, act to oversee that CapEx. So we call it CapEx management. So they do the CapEx management. I think that covers, the functions of the core team, and we can kind of, let the panel maybe work. We'll talk a little bit about that as we get past here, the next slide, which is really the supporting team. So we'll talk supporting team. I lumped brokers and advisors under one, sort of function, although these are very specific functions. Obviously, you may have, a real estate advisor. So the real estate advisor is telling you where they think you should invest. Maybe you're having feasibility studies done about types of investments. So you want to do assisted living facility. Is this a good place to put one? What cities need it? So there's a lot of advisors that can fall within that role. Do you need them? It depends on what expertise you have within your team, but certainly that's one of them. You'll have mortgage brokers there. The mortgage broker we talked about, they're basically going to shop loans for you to try to get you the best deal possible. I mean, obviously that is one of your, month in, month out, one of the biggest costs. The biggest cost is paying off the leverage part of these deals, which is usually the majority. And so they're going to help get you that best loan that you possibly can get. There's a cost to that, right? There's a cost for that service, but certainly if they do it right, it's worth the effort. You have insurance brokers as well. You do need to, when you go out and go after these assets, you do have to, upfront identify how much the insurance is going to be between your insurance and your next line, which is your tax. Normally you have tax advisors, or at least somebody that can kind of gauge how much the taxes are. Those are two of your biggest costs outside of the obviously paying off the loan. If you have an interest only, that's still a lot of money that's going into the loan, but then you do have to really consider and make sure you get the best analysis or input that you can to ensure that you factor in the true cost of that real estate tax and the insurance. Those are big ones. The other thing there, we talk about a rate cap. That's another type of advisor that can essentially, if you have loans that have floating rates or variable rates, sometimes you can work with a rate cap advisor and lock in a rate cap so that you have limited, you can't, if interest rates go up significantly, you kind of block at a certain level. And if it goes up higher, that rate cap actually in insurance will pay for the difference if it goes above what that rate cap that you paid for is. So that's kind of those. And then of course, on the lender side, they are your biggest investor. A lot of these lenders are putting in 75% of the deal. And this is a little different if you've never done a multifamily acquisition. The lenders are much more active in these type of deals. If there's a value add component to it, they want to inspect. They're certainly going to manage the CapEx money. In many cases, they essentially hold on to it and they pay it in draws, so that you have to complete certain things before they're providing these funds for doing the renovation, which you will, obviously you want to, the more you can leverage, the loan is definitely cheaper than bringing in additional investors that want obviously higher returns. So, but they're your biggest customer, your biggest investor. So you always have to, keep them in mind and work with them through the process. And obviously making sure that as you're going through through the acquisition at the very beginning, you understand the terms of that loan in detail. And if you don't, that's where you have your advisors. If you're not familiar with that, we also have not just advisors, but you can reach out to your legal entities. You have two types of legal entities that support a syndication. First, you typically need a real estate attorney to close the deal. These are very large deals, and there are actually groups of attorneys. The lender has an attorney. You will have your attorney. The seller has an attorney, and these people are all working on these deals. So it's a little bit more sophisticated than your typical, buying a house, where it's essentially just, if you have one attorney, it's really the one that's actually, it could be the title company that's actually doing the closing versus actual attorney. When these, you have groups of them. So your real estate attorney is focused on the closing. Then you have your securities attorney. That's the one that's actually putting together the syndication. They're laying the groundwork that allows that syndicator to essentially, through an exception, raise capital, which is basically selling securities. So there are exceptions that the SEC attorney has to put in place through a private placement memorandum, and there are filings that have to happen at the end when you do close, and you close that actual syndication. They have to provide reporting to the government, and so very essential that they're involved from the very beginning. Really can't do this without them, so it's critical. All right, so this is kind of the first point here before we go into the next slide, where I have the panel to address some of the things I covered, and if they want to kind of chime in on one niche or another within that structure, this is the best place to do it. So I'll turn it over.
Hey, Ray. So hi, everyone. Kelly Iannone. Nice to meet everyone. I wanted to kind of touch on your point about investor relations and passive investors. And one of the things, as you guys saw with my background in corporate and working for a company that is so guest focused, is that our customers are the lifeblood of our business. And not only the residents that live in our apartment buildings, but also our passive investors. We don't have a business if it's not for the passive investors. So making sure that we really understand the investing goals of our passive investors so that we can advocate for them. And also making sure that as we go through the life of a particular project, that we are curating what updates we need to be providing to those investors so that they can feel confident throughout the hold period that their capital is being used, obviously, to the best that we can use it, and that their returns are being met based on the projections that we had in the project. So that's one thing that I love to emphasize, so that lens is there. And to your point, Ray, of making sure that we're not only protecting investor capital, but that we are amplifying it and getting the returns that we originally projected, and making sure that our investors continue to be part of the conversation and that we're advocating on their behalf.
Yeah, we don't do too many deals when our passive investors aren't happy. That's for sure.
No, we don't.
Any other?
Hey, Ray, if you don't.
Oh, there you go, Tim.
Yeah. Hey, Tim Little here, Zana Investments. So I just wanted to hit on a point that you made earlier, because I think it's something that you can easily breeze over, but I do think it's important, especially for those folks who are aspiring to be GPs, to be on the active side. And that is that not all GPs are managers. So basically not all GPs are created equal. And I think this is something I didn't realize, when I first switched over to the active side. Having only done, passive investment, in my eyes, a GP is a GP. Like there's no distinguishing. And I naively thought that, and was so excited to even be a GP that I didn't really consider the significance of my role on that team. And so, I came in ready to go. And then I was like, hey, I found myself finding out about things after they happened. and not having a whole lot of input on things that did happen. And I didn't really understand why until it was, made clear that like, hey, there are some decisions that are made, like you said, by those managers, and I was not that, and that's okay. But it's just that lack of knowledge again that I had coming into it. So I think again, as those aspiring active investors go in, that they understand the different roles, and if that's something that they want, if they want a greater role on that team, well, then that's something that can be negotiated. But that may be a matter of bringing more money or more resources or whatever that case may be. And the same holds true for asset management, right? I also, when I first got into this, just assumed that everything could be counted as assets under management because I saw everybody else saying it. Until I think you were the one who pointed out like, hey, if you're not on the asset management team and collecting, an asset management fee as a part of your duties, then it's not really assets under management. So, it's a very fine distinction that I think people who are first starting out don't really know or may not be aware of.
Everything is negotiable, including your fees, which is another whole topic. But yeah, you're absolutely right. Got to pay attention to those kind of details. Thanks, Tim.
Good day, Ray. Thank you for the invite. Just wanted to add, a different view on syndication. It's almost like a football team or a baseball team. You put together your players. Everybody can't be a head coach. Everyone has their own role. You need to have your supporting cast, which is your assistant coaches. So you got to look at it from a sports point of view, and you trust the team. Everybody has a role. Let them stay in their lane and do their job. But every person has a responsibility. Need to have a support system within the team. You don't leave them out there on his own because sometimes they could run into some type of help that they need. You don't want to leave them alone. So it's a team sport, and that's how I approach syndication.
Absolutely, that's one of the things that really attracted me to this is versus single family, that you really can't do this alone. I mean, you can try, but I don't know how successful you can be if you're trying to do it all. There's just too many pieces to it, and the beauty of it is being able to work together in a group. Certainly in the military, we're mission focused, and we're all doing something from a mission perspective. And this is very similar. I'm actually going to use those similar terms as we go into that framework into the next slide. Pano, is there anything else you want to add before I go to the next one? Good. All right.
Good.
So this is the framework that I've mentioned a couple of times. And I think when you add these pieces together, you really have the ingredients for success, assuming, as I mentioned, that the deal is a good deal, right? It doesn't even have to be a great deal. If it's a good deal, a good syndication will squeeze everything they can out of that thing and really make it work. But the opposite is also true. If it's a good deal, you got a bad team. If it's a great deal with a bad team, you may just squeak by. So it's important that everybody within a team understands the purpose, and there has to be unity in that. And we're going to go into these a little bit more. But you have to have unity of purpose and effort in order to have a successful syndication. And let's break that down a little bit. So let's talk unity of purpose first. I think the biggest things is, we have to have a clear mission. And so a lot of people say, well, we know what the mission is. The mission is to buy multifamily. Well, there's more to that. There's more to it than that. I mean, are you buying do you have a criteria for your procurement? Are you after value add deals? Are you looking at stabilized assets? What type of assets? Are you looking at B class? Are you looking at C class assets? Where are they located? So there's a whole piece to a mission that you kind of have to have in place that goes a little bit deeper than just certainly, we're just acquiring properties. When you have that kind of a vague mission, you have certainly what we would call military mission creep, and you just kind of lose the focus, and you're not really going after what you started. So you really have to have very clear missions. you have to have clear objectives of how you're going, what you want to do with that asset. Do you want to take an asset if it's a value add asset? Is the objective to show people that you can raise rents by renovating a small portion of the units? Or is it to renovate a large majority of the units, do a cash flow play where people are getting cash flow for a while, but you leave enough meat on the bone for someone else to come in behind you when you sell that asset? You leave enough meat there for them to be able to kind of use a similar type of approach to gain value. What is it you're doing, right? And so, do you want to do one, or do you want to have a focus of one and maybe have the other one as another exit plan? And so when we talk about a robust business plan, you may have an objective that is one way or a type, but as part of your business plan, you want to have multiple ways that you can get out of that asset successfully. And so you have to have almost like a branch and a sequel to your typical plan. So when we talk to investors, we generally give them the main plan. This is our focus. We're going to hold this thing for 5 years. This is what we're going to do. But it's not discussed, but it's very possible that we could sell that asset in a year. If we can double your money in a year instead of 5 years, why would we go through the trouble of holding it for 5 years when we can give you that now or in a year, right? So there are certain things that we can do. Or if the market looks like it's going to turn, maybe we just need to capture the gains at a particular place, whether it's what our initial plan was or not. But having those clear objectives and then having exit plans as part of a robust business plan is key to all of this. And then also to be able to get to the point, probably the most important part of this particular slide is you have to have operational processes that are established ahead of time that allow you to make decisions when you have to make decisions. And there are certain sort of triggers that you pay attention to that you know up front that these are the things that you have to pay attention. When these things happen, something has to happen. There's decisions that have to be made. And there's also decisions and processes, not decisions, processes for day-to-day operations. Every week on these, at the very least, 2 or 3 times a week, we're engaging with different stakeholders in these acquisitions, whether it's the property manager, whether we're engaging with the other general partners, whether we're engaging with the managers or with the attorneys. And so there has to be some process by which these things happen in a very sequenced way, and you're able to capture the essence of these meetings. And you're going to these meetings and you're getting something out of them, not just sitting there and you're just listening in, right? And things are happening around you and you don't have that in place. So you have to have those. And I think that's where when you create a new group, one of the things that happens when you're creating these syndications, sometimes you don't have your entire group together. I mean, and that's good because that gives opportunities for new members to come in, or you may be creating your own group, but very soon after you do that, you have to onboard people, or you have to at least give them the processes that your team has in place so that they understand this. And then a lot of people don't even have those processes, much less they can't even explain to someone else. They just think, okay, show up at this meeting. And so, I'm sure it's never that bad, but I've been to some where you wonder what's the purpose of this call. We're just on a call for the sake of being on a call and not really having a process by which we're going to make some sort of decision or take actions or anything. And so I've seen it. So I'm going to hold there and let the panel talk about this. Maybe there's some examples they want to give about something like this, and maybe a little bit more clear than what I provided.
Sure. I just want to touch on the clear mission. I'm gonna tie in your underwriting with your clear mission. When you're looking at these deals, you always want to have that buffer room for your what ifs, right? You go in with your business plan, but you have to stay flexible because we really don't have a crystal ball. We would love to have one, but things happen in the market, pandemics happen. These are unforeseeable things that's going to happen that you are not prepared for. But if you do your underwriting and you leave a little bit of room for those what ifs, that should guide you through to the exit.
Yeah, and I think that something's important to add on to Winston there is adding that little bit of buffer in multiple places. So one of the things that our team does a lot of is we'll do stress testing on what does break-even occupancy look like. Again, that preserves investor capital. That doesn't return it, but that is our break-even occupancy. And looking at in this environment, when we're talking about compressed cap rates, well, with interest rates increasing, a lot of discussion of cap rate expansion, what are we putting as cap rates for the refinance or for the sale, and making sure that we have buffers in those places, as well as when we're looking at market rents. The growth that we've seen in the last two years is fantastic, right? We're not necessarily forecasting that velocity of growth is going to continue. So again, having another place of conservativeness in that underwriting is imperative. And that goes back to the point I made last time about, at the end of the day, our investors are our business. And so making sure that we can return that investor capital as we projected, and even beating it, right? Under promise, over deliver. That is part of how we are able to do that.
Great point.
Yeah, right. And the only other thing I'd add to that is that, we talked about having that selection criteria, codified, and you should write it down, and the entire group should understand and agree on that. And it's something that should guide you, but not necessarily confine you. So if conditions change, or if an opportunity that presents itself that might be a little outside of that criteria, that's okay. That's when you get the group together, you talk about it and say, hey, this isn't exactly what we usually go for, but here's the opportunity. And if everyone, is of the same understanding and agree that it's something they should move forward on, then you take that opportunity, and maybe you even adjust your criteria after that.
Yeah, flexibility is definitely one of the tenets of good operations, and that's exactly true. And I think you tie in perfectly. Unless the panel has anything else, we'll jump onto the unity of effort, because I think it's important that as we talk about how we go about informing the team, unity of effort is probably, once we've got the purpose down and we have our procedures down and we know what we're doing, unity of effort is where things can break down, and they erode, because this is where the magic happens on a team. Yeah, once you set that initial criteria up and you've kind of have those processes in place, and you're able to acquire an asset, that kind of happens pretty quickly on a deal, especially when you're talking 5 years, right? But the unity of effort is where things can break down. And what I mean by that is, I talk about a common understanding. Certainly, I've had the experience of being on teams where you don't know what's going on. And, and we talked about it, Tim, like you said, I had the same experience. You go into a team and at the forefront of your first deal, maybe your second deal, you're not exactly sure what you don't know because you're not being informed of it. But you certainly learn that very quickly if you're not getting the information. So I think transparency is so key to these organizations, because there's too many places where you can have, stovepipes of information. You have, certainly, if we talked about the managers versus the general partners, yes, the managers may make decisions, but when the managers filter the information that gets down to the general partners, it doesn't allow for those general partners to feel like they're part of the team, and they start whittling down. And there's a lot of experience and a lot of things that you can get from that general partner group, that if you don't provide them what they need, they're not going to be able to help you. And then it's going to feel like the managers are doing it all. Well, it's like it's self-inflicted, because you're not empowering the team to be part of the process, and you want them to just jump in and give you answers when they don't have certainly the background. Maybe they're not on the emails that are going back and forth on these points. So transparency, I can't harp on that enough. When you have a team, you want to be transparent, you have to over communicate. You think you're communicating too much, you're probably not. So take the time, come up with methods to do that, whether it's a Slack channel, you have your weekly calls, maybe you have, depending on where you are in the deal, maybe it's more than weekly, but you have to talk and you have to communicate to really get a unity of effort. Because when you have good unity of effort, people do things, they anticipate problems and get ahead of it. They get ahead of those things, and they're able to kind of make the deal go better, as opposed to reacting to when things go bad, when it's just a few people that are doing it. So I think that that's really important. Obviously, we talk about progress. We talk about measuring progress, and certainly that's something that's done as part of your purpose, and you're establishing your operations. But those measures are going to be assessed during your long acquisition, and that's normally your unity of effort team, your general partnership, your entire group that is able to, from their asset management roles, help you see and analyze these deals, because there's a lot to them. What is the leasing effort? What, if you have, what's the occupancy? What are your, what bills do you have to pay? Are there any bills that are behind schedule? Do you have enough vendors? Do you have enough estimates? There's a litany of things that have to be looked at on these things on a regular basis. And that, if that's being weighed, done by 3 or 4 people, you're kind of missing the boat. You kind of, because then now you're never able to get to maybe that second and third order effect that you need to get to, because you're having to do all the day-to-day things. So with good, measures of effectiveness and people assessing those things during your meetings as part of your unity of effort, operation, then you can really get at some of the issues that can go wrong and get at them before they really throw your deal down the wrong way. And then now you're sort of reacting, and you're having to tell investors, yeah, I was going to pay you next quarter, or next month, but gee, this thing happened. And sometimes those things do happen, and they are immediate and you can't anticipate, but not always. Not always. Sometimes you can anticipate them with the right team, the right, unity of effort, and everybody being involved in assessing the performance of an asset. So I'm going to hold there for the team to weigh in on that.
Just want to add something to this. It may ruffle some feathers, but hey, it's just being honest. From an investor standpoint, even as a syndicator, if you're reaching out to a potential partner, he's not responding to your emails, he's not responding to your phone calls, that's not the partner you want to go with. That's an individual that's on a different mission. He's not going to communicate step by step with you. You may have a hard time catching up with them. So if you reach out to them and they're not responding, pass them up. No, you don't want to hear from him when he's trying to raise for a deal. You want to hear from him beforehand.
Yeah, you definitely want to vet these folks as much as you can. And in this business, it's easy to do. Just call someone that's a syndicator and ask them, do you know such and such? They may not tell you the ground truth, and they may not say, oh yeah, you definitely don't want to do anything with that individual, but you'll get the hint without them saying too much. It's like, yeah, I know him. Versus, oh, that's an awesome guy or gal. You definitely, oh yeah, I love him, right? So you get that tenor from those type of calls, and you can vet people. But yeah, for sure, figure out who those folks are that are running these stovepipes and get away from them, because they're toxic. They're toxic to the team. And then when they're in charge, that's even worse. So you definitely want to make sure that you kind of paying attention to those things as you're putting a team together or participating in a team. Thanks, Winston.
Hey, Ray, I think another important part of that team dynamic is having the roles and responsibilities clearly delineated, like before you ever close on a deal. And like you said, you want to have not only that primary person, but an alternate. And the reasons for that are redundancy, right? Like, we're all very busy individuals. Some of us are, still have the W-2 jobs. We got families. Things are going to come up, and we may not be able to make that one meeting. So we need to be able to reach back to whoever that alternate is, or the team at large, to see if they can cover down. But you definitely want to have those roles and responsibilities identified ahead of time. That way there's no confusion, and you always have someone who's looking over your shoulder too. I.e., me and Kelly doing investor relations, she does the initial draft. I can go behind her, be that second set of eyes that may catch something that she didn't see because she was too deep into it, looked at it too many times. So I think that's important as well as you're building your team, as you're getting into deals, delineating those roles and responsibilities ahead of time and not trying to do it on the fly, because by then it's too late and you're inevitably going to drop something.
Well, that's a great point, Tim. And I was going to bring that up too. And us working on investor relations for some of our projects together is perfect. The team has weekly meetings where we're talking about the projects and the asset management of it. But what's happening in the background is understand the individuals that are primarily responsible for specific tasks. We know what our deadlines are. And when we need to get drafts of investor communications, for example, out to our internal team to then be vetted by the larger general partnership management team prior to even going to investor relations. Those things all happen in the background while we are still continuing the day-to-day oversight of property management and the construction. And that's where that communication and having those roles clearly defined is so important. We're not spending time going, who's doing this month? We know who's doing it and it's getting taken care of.
Absolutely. You know, and I think that's one thing that probably could harp on some more is that good syndication teams aren't afraid to tell investors when things aren't going well. This doesn't mean that you just tell them, you know, every little thing that's going on in a project, but it does mean that you're keeping them abreast of the issues. And more importantly, you're addressing how you're going to solve those issues. That approach is much better than I'm just going to try to solve this thing. And then, I guess if I can't solve it, then I'll tell investors that I can't pay them next month. Right. I mean, that's an extreme. It's maybe doesn't always happen exactly like that, but there's a lot of people out there that are afraid to tell their investors when things don't go right. They understand that things happen. What they want to know is they have a responsive team that's going to keep them informed and is going to try to right the ship. You can never, I was always told this, and it's like bad information doesn't get better with time. It gets worse. And so you want to get ahead of it. You want to come up with planning, you figure out how to fix things and then let your investors know. I would also add, Tim, you made a point about knowing, I think it was Tim or Winston, about knowing the roles. And one of the things I have not talked in this presentation about is I sort of briefed and kind of glossed over decision-making and that the managers vote. But, depending on the team, you don't necessarily have to have, a chief involved or a CEO kind of person. There are ways to structure these, especially if you're partnering on huge, large deals where, essentially you want 2 or 3 people voting in one way or another for decisions to be made versus just one individual or one entity that gets to, vote over everybody. So I like an organization where you have 4 or 5 entities and, you need at least 2 or 3 entities to agree on something that then will become a decision that is made. I'm not talking about places where you can never make decisions because you never have any consensus. That you don't want that either, but you certainly want to have a structure where people have a voice. And certainly if you may have a good idea, somebody may have a better idea. And so there are ways to structure these things and that are more collaborative versus kind of, very rigid roles of, I'm in charge, I make the decisions, you guys just give me some advice and I'll decide. So not that one or the other won't work. It certainly depends on the organization, but I think you get better unity of effort when you have that collaboration versus, somebody just kind of dictating the way they want things to happen. Okay, let's talk a little bit more. We talked about some, I think we got into a little bit about the pitfalls. I guess before we talk about some of the pitfalls, let's talk about this process, which a lot of entities forget. And certainly on the syndicator side, I actually have to remind myself, okay, we just closed on a deal. Fantastic. Now let's go back and take a look at that deal and figure out what we could have done better, what we did good and what we can sustain and what we didn't do so well that we had to kind of adjust on the fly that we can fix so that the next time we run into that situation, we have a better process to deal with it. And a lot of people, I think they just go from one deal and they want to go right into the next one, and they never stop to sort of reorganize and to kind of reconstitute and figure out, okay, how do I optimize my organization before I go jump into another one, right into another deal? And so I think it's important that people figure out how to do this. I mean, the military, I think, for me, that was obviously, we didn't do much in the military without having what we call an after action review, right? Where you go back and you talk about, here's what we did right, here's what we didn't do right. You got to have some thick skin, right? Because you may be the one that was involved in a decision that wasn't the best decision. But the idea is, if you have a good organization, everyone's going to understand that it's not that you're picking on someone, you're just trying to improve a process. And I think so long as people are professional about that, I think there's a lot of goodness in doing these, not just going through the motions. I mean, because you can go through the motions. I remember doing this. We want to do this in one syndication that we got done with. We did, and it felt like it was a little bit going through the motions, and that's not going to work. You really have to, the leadership, everyone has to embrace this in order for it to work. And then you have to actually save these, so over time you don't forget the lessons. I mean, there's one thing to kind of go through and say, this is what we did wrong, and then you go right into the next one and you do exactly the same thing wrong. It's like, you got to learn from that. I think it's important that people take the time and don't just rush from one deal to the other, but figure out how to do these deals better. I guess let's just hold off to the next one. I think it's because we can have the panel bring in on both of those. Let's talk about some of those obstacles and where people can go wrong, right? Or where teams can go wrong. We talked about transparency. If you have a lack of transparency, certainly the team, the rest of the team is going to feel it. You may have all the information. The small group can have the information, but you won't have the wherewithal to be able to do all the things that need to be done. And then you're going to lose the rest of your team. And then essentially from then until the project is completed, your 2 or 3 people are doing everything, because you essentially cut everyone else off. And and so they're going to feel frustrated. They may not want to work with you again. They certainly are not going to go and give you their best, because you haven't gone through the process and to the trouble of keeping them informed of what's going on with this business. And that's a requirement. I mean, a general partner has to be an active participant. That's what the SEC says. So be part of that solution, not part of the problem with that transparency piece. The other one, and I kind of touched on it a little bit on the other slide, is when you have a lack of resources, or you're stretched too thin. It can happen for several reasons, but one of the ones that I see a lot, and I talk about this because a lot of people have this in their mind. When you hear them talk, they talk about, I want to do 1,000 doors this year. I'm going to do 1,000 doors this year. Well, that's great, but what if you can't return the type of returns that you need to investors? What are you going to just go after the doors just because? No, you can't be that focused on numbers. The numbers that you have to be more focused on is, how do I make sure I give people my return? And if I'm jumping from deal to deal to deal to deal, eventually it's the same people. And I think Tim mentioned it. I go to on any week, I'm dealing with 5 or 6 different assets that we're maybe in the process of acquiring, assets that we just acquired, assets that are somewhere in the process, and maybe 1 or 2 that we're selling. And this is kind of like the whole thing, right? And so unless you grow your organization and you do that in a methodical way, you're gonna find yourself with a lack of resources. And now you're not able to execute what you need to execute on any particular deal. And you're really now not giving investors the kind of returns they could get. Maybe good returns, but they won't be the great returns because you just don't have the time. So stop thinking about all these deals you got to do, and do the ones that you have and do those right. The other thing is that's important, and I think it's in this business, there are fees that are provided to the active team. There's a lot of work that happens, right? So it's not that I disagree that there should be fees. I get fees for going after deals, and when we don't get them, I lose money, because we do due diligence and we spend time and money and we travel and we do all these things, and then we didn't buy the asset. So when we get fees, that's great. But I caution people that are in deals with people that must do a deal, must have their fee, or the business falls apart, because that's when you reach. When you are no longer serving your investors, but serving your fees and your lifeblood, because if not, you go out of business. Now you start going after things that you shouldn't. So pay attention to that. Ask people, how many deals do you have? What's your organization look like? Who are your asset managers? Understand their team and figure out where they're at. And then, pay attention when they say, I got to do 10,000 doors next year or this year, because ask yourself, how are you going to do that? How are they going to do that? And how are they going to care about your particular deal when they got 5 others that they're going after? So there's a lot of things there that, both ways, just on the active side and also as a passive investor, that are important for you to pay attention to. And then the last, it's sort of same thing, competing priorities. If you have multiple deals, if you don't have processes and you're, you just basically running around with your head on fire all the time because you don't have these processes in place, you spend a lot of time and you're not really getting anywhere. You're not really doing anything. And again, have some sort of decision-making structure, something that allows you to move forward, but with input and, certainly with a unity of effort where people can provide, they feel like they're valuable to that organization because you will allow them to provide that expertise. If they're not an expert, if they're not really valuable to your organization, then they shouldn't be in your organization. They're going to bring you down. So get the right people in there and then value them and let them be part of that process of decision-making. All right. There's a lot there.
I just want to add to the stretch too thin part. What we do as syndicators is we invest alongside our investors. We have skin in the game. So when you're starting with a group that has skin in the game, the goal is not about the door count. When you don't have any skin in the game, you don't care. You just want the door count because it sounds good, but the asset's not performing well. Well, for us, we want to make sure it perform well. Just as we pay non-investors, we invest in alongside our investors. So it has to be a sound deal from day one.
Yeah, skin in the game. Anything else, Kelly or Tim, on this one before we go into the round of questions? I think that's the next.
Yeah, I guess the only thing I would add there when we think about obstacles, I think we always talk about what's great and what's going great. Real estate's fabulous. I think what we miss sometimes is that being active in real estate is really hard sometimes. And just the authenticity of the grind that it can be, and having the transparency and the communication within a team. And you talked a little bit about decision structures and making sure that you've got the right players who can make decisions, and that you don't have so many people that make the decisions that nothing gets made, but you have at least a couple folks that have to buy into it in order to make a decision. One of the things that I've invested in single family, I've done a small multifamily, small mid multifamily, more individually with just my husband and I. And then of course I've been in part of these syndication groups. And, one of the big things that I've kind of cemented is, especially as I've gone through this mid-size commercial property, just my husband and I, we're making all the decisions and everything falls to us, is that sometimes there are so many obstacles that get thrown at you that you have to just you have to evaluate the big picture and then break it down and go, what is the next best thing we can do to continue to move the process forward? I have a saying that the only way out is through. There's no going back. You have to keep moving forward. You have to figure out what is that next best decision in order to make. So I think that's one of those things that we don't talk about enough, and just broadly, is the obstacles that do come up in real estate, and that it's so imperative that you're investing with a team that has the communication and the transparency and the trust in each other. And that if you're building a team, that is a core value of that particular team, because things are going to get tough. Decisions are going to need to be made, and there's going to need to be some difficult conversations, and having the respect and trust of each of the team members in order to hear each other out and then make the best decision and everybody buy into that is imperative to the success of any syndication.
Great points. Anything else before going to the questions here? I think that's it. All right, there's the quote, right? Teamwork makes the dream work. Not just going through the motions of teamwork, but actually doing it and actually being part of that team and actually allowing, if you're sort of in charge, allowing others to be active participants in that success. While we let the audience kind of think through some of the questions, describe one deal that you passed up because of the composition of the team or actions or failure to act of that team.
I have one. Hopefully they not want to hear it.
No names.
Yeah, I'm not going to get into names. This was a deal in Texas. Someone approached me through LinkedIn, and they were trying to, I guess it was a joint venture, not even a syndication deal, but every member that was on this deal were a part of their family: mom, dad, sister, brother, uncle, cousin, and just me. I just didn't get a good feel of that one. I had to pass. I think that my voice would have been drowned out. So it was just too risky for me. Even, the deal seemed good, but just the structure of the team was too risky to move forward. So I had to bow out on that one.
They would have had to adopt you or something, huh?
Yeah, and I didn't get a good feel of it. It wasn't going to work for me.
Yeah, I'll share a recent deal that our team was underwriting, and the numbers looked good. It was in Georgia, probably about 3 hours outside of Atlanta area, and we own other assets in the Atlanta area. And one of the things that's so important to the team is making sure that we have somebody that, we call boots on the ground, or somebody that's in the local area, an hour, 2 hours away, that can drive over there and really have eyes and ears on the property, make sure that whatever, CapEx stuff is supposed to be getting done or property management things are supposed to be getting done. And this particular property was just far enough outside of that range that it didn't make sense. Now, we went through the process of trying to identify if there was anybody else in that market within our networks that we might feel comfortable bringing into the team in order to play that role. But at the end of the day, we couldn't find that right individual. And the folks we had on the team already were just too far away from the property that even though the numbers worked, we didn't have the right team in place for that particular asset in that specific location. And, at the end of the day, we walked away because we just weren't confident in not having that spot filled.
Sometimes the best deals are the ones you don't do.
Exactly, Ray. But we wish somebody else well on it.
Yeah, and for me, I guess I would say an example, not necessarily of a deal that I passed on, but of like teams that I've worked with in the past that I probably wouldn't work with again. And that's largely goes back to your whole point about transparency, communication. It was one of those things where, good communication at first, but as time went on, the calls, the emails, the invites to meetings became fewer and fewer and fewer until I felt like I was relegated to being a passive investor in the deal. And it was really frustrating. And I could see that team was, moving in a different direction with their goals and what they were doing. So not to say that, the deal itself didn't hit it out of the park, because I am very happy with the returns that came out of that deal. But in terms of some of the folks who were the lead on that, I probably wouldn't partner with them again for all the reasons I just mentioned.
Good stuff. Anything from the audience before I go into my next question here?
I got a question, Ray. Can you hear me okay?
Sure can.
Yeah, this is Jason Atienza. I'm calling in from Orlando, Florida. I met Kelly through LinkedIn. Hi, Kelly.
Hey, Jason, good to see you.
Good to see you. Thanks. So my question for you all is for your investors, your individual investors, for example, what is the most common question or concern that you get from these individual investors? Let's say when they call or text you at 2 a.m, what is it that they're calling about?
When's the next distribution?
All right.
Yeah,
Try-
it's not even just when's the next one, like especially if it's at the beginning of a deal, it's when's the first one. Because that can vary from deal to deal depending on, you know, how heavy a lift it is from a, you know, reno perspective. Some deals you may start making money right out the gate and be able to give that you know, distribution to investors right away. And others, like, you know, deals we have, it's a heavier lift. You're starting at zero occupancy, and it's going to be 9 to 12 months before they see that first distribution. Not all investors are comfortable with that, but you know, that's where you got to be, you know, transparent up front about, you know, what that deal is, when distributions will likely start coming, and then keep them informed all throughout that process if that timeline changes even a little bit, so that they don't feel surprised by any of that information.
I think that's great. Great, Tim, here. I'm making a note so I don't lose my next thought. I wanted to add on though, because I was literally just having that conversation. Ray and I chatted about it a little bit earlier today. I was literally just having that conversation of when distributions start for a potential investor, and talking about, you know, some deals that we have, to your point, heavier lift. It may be a year before we see those first distributions. Other ones that we're making money right out of the gate, but we're still not going to do distributions until we hit month 6 or so, just so that we have an opportunity to really settle everything and make sure that we've got our reserves where we want them. And part of my conversation with this individual was to also be aware that some syndication groups will start providing returns right away. And you have to ask yourself and ask them how we're able to do that. Because what I've seen in some groups is that they over raise in order to have the capital available to do distributions initially. And what that does is that dilutes passive investors' shares. So that's just something to be mindful, and that may work for some investors because they want that certainty that, okay, I wired in my 50,000, I got something back. That's my validation that you didn't skip town with my money. But that's something that's important to know. What I was jotting down with, going back to your question, Jason, of what is the question, you know, you get at 2 o'clock in the morning, and this is going to be mainly before you know, finalizing on a deal. But one of the most often questions, it's getting late, most common questions, there we go. Most common questions that I get is, how does this go wrong? To a lot of people I speak with, this is the first time they're hearing about real estate syndications, and they're used to seeing, you know, they're doing a lot of investing in the stock market, and they're used to that 8 to 10% average return over the long term. Yes, it's been really good the last couple of years, just like everything has. But when you talk about those standard returns, when they start to see 18, 20, 22% annualized returns on a real estate syndication, you know, that saying, if it's too good to be true, it probably is. So the question I get in the majority of my conversations when educating individuals about investing in a syndication is, how does this go wrong? And that's where I really take that conversation to talk about real estate being a hard asset, and that, you know, everybody needs a place to live. Let's think about the 2008 housing crisis and how, you know, what was the environment of what transpired there. Obviously, our fundamentals are very different today than they were back in 2008. It's not the same situation. But just kind of taking them through the path of, here is how things go wrong. And then to my point earlier, what is our break-even occupancy? You know, we just acquired an asset that when we closed, we were at 100% occupancy. Break-even was, I think, 73%. So in what world do we end up at actually 73% occupancy? And really just sharing, here are all the ways that we're protecting the downside in order to preserve that capital. But that is a question I get very often, is, how does this go wrong?
Great. Thanks, everybody.
You was muted, Ray.
Any more
there
questions
you
from
go.
the audience?
Yeah, I had a question kind of in line with what you were talking about with investor expectations. So a lot of the deals we're seeing right now kind of require most likely bridge debt to go in because of the debt service coverage ratio and the fact that it could be mismanaged. However, the broker is still looking for, performer on their pricing. So a lot of the underwriting we're doing is showing, what you were just saying, that first year, even potentially year and a half of little to no distribution. So I was curious from hearing from your investors that their expectations could potentially change if this environment continues. Are they likely to be okay with those distributions perhaps being 12 plus months out? Does that make sense?
I think I'm going to punt on that one. I don't have enough examples of 12 plus month distribution projects to provide feedback on. I think Winston, you unmuted. Go ahead.
Yeah, it depends on the condition of the asset, right? If you're buying an asset, it's a heavy lift. Well, you're going to need time to stabilize that asset. So you're going to go in, already with a game plan of being able to hold it for at least 12 to 18 months to get it stabilized. And it really depends on that condition. And of course, what ties into that is that type of investor. That may not be suitable for an investor who want a quick return. That's suitable for an investor who understands the business model and they've been down this road before and they're willing to wait. So there are deals and that will start in 90 days and there's some 6 months or a year and a half, some longer than that when you're doing a new build. So it just depends on the type of investing you're getting into for the most part.
Mm-hmm. Okay, I appreciate that. Thank you.
Any other questions from the audience?
Yes, Ray. I have a question. Earlier I was talking about my first LP that I got involved with this deal. So I'm wondering, because I didn't read through the entire PPM, is there areas in there I can find when would be the first distribution? The dates, do they usually list dates in that PPM on distribution? Because it's only been 3 months, 3.5 months probably since I got in. And I'm just wondering, I know I can call the folks, but I could just read the PPM and it should be in there, correct?
I can jump in on this one if you guys want to.
Well, he was asking you. That's why.
Any of you guys can answer. Whoever has the knowledge on that, on the distributions in the PPM.
Well, I would say, Robert, that there are places within the PPM, and there are some differences depending on what attorney does it. But within there's normally a statement that reads something to the extent, because I don't think you're going to get someone to lock into a date like, hey, 6 months from tomorrow, from this date, you're going to get your first distribution. But there will be something on there that will set that, shape it to say, expect first distribution 6 months from acquisition. And then there's probably a line in there that talks a little bit about some discretion from the managers about distributions, depending on what's going on within that deal, right? Because we're not, if the deal is not in a good place for a distribution to go forward, they reserve the right to not do that because they have to be able to pay for all of the expenses. So it should tell you that. Now, where it'll be much more clear is in the presentation that goes along with the PPM, because the PPM normally has a business plan associated with that. So you'll have the legal kind of PPM, and there's normally a presentation in there. And one of the key things that should be on there is expected distribution dates and timeframes.
Okay. And I know there were language in that talking about, what's that called, where the investors, the LPs get their money first before the everyone else, on the
A preferred
team.
return.
Yeah, it's definitely a preferred return. So, but yeah, I'll look through there and look at the presentation. It was videoed and all that, and I'll read through it. Thanks a lot for your help.
And Robert, don't hesitate at all to reach out to whoever it is that brought you in to ask that question. That's what they're there for. I mean, there's normally somebody that you should be able to reach out to and should be responsive to your questions. I have questions like that all the time, and it's a great question, and I need to be able to answer it. I need to be able to provide that feedback to my investors because I want them to feel comfortable in the deal so they can get into the next one, because this one performed and they got the information. Sometimes not providing people communication and it still is a good deal, they'll still have a bad feeling about it because you didn't communicate. So it could be a great deal, great return, but like, I'm not going to work with this person because I'd reach out to them and they wouldn't talk to me. So yeah, no, that don't feel like you have to go digging around. Let them tell you.
Yeah. Okay. Thanks. I'll
absolutely echo what Ray said. Don't hesitate to reach out to them at all. They should be very responsive to you.
Mm-hmm.
All right, let me ask another question while we get the audience to think about some more questions as well. Have you ever played a different role within separate teams of a syndication? So in other words, one where you had a little bit more, your function was, slightly different or a lot different than on a different deal.
I can kick this one off. So I've been in 3 syndication projects or deals that I've been on the same syndication team. So I've not been on a different syndication team with a different role, but I have performed different roles when doing like single family flips or with partners, and roles within that team was very different. So more project day-to-day, well, not day-to-day, but project management of the construction timeline. When are the different subcontractors and contractors getting in and out with their roles? When do we need to make sure we have materials on site? Walking the project to make sure that all the updates are being done and being done to the quality standards that we'd want. So more of a boots on the ground type asset management type of role, obviously much smaller scale. But I think it goes back to the conversations earlier about being able to play in very different roles. That is not so much my role in the current team that I'm on. I work much more in educating and investor relations, and then partnering with, poking holes in underwriting and making sure deals that we're looking at make sense, and just supporting the group with the asset management work as well. And Ray, you are on mute.
I was going to say, I would be the first to tell everyone that you can do a lot of different things on a team. And that's one of the things that I look for in partners, is those that can flex when you need them. And that's critical. Yeah.
And even to add to that, Ray, that's one of the things that, I do work a W-2 job, and some people aren't comfortable with investing with somebody who also has a W-2. There's sometimes a perception that I'm not full on dedicated to the real estate work. But there's a lot of work that gets done in real estate outside of typical business hours. And that experience that I bring from my corporate role, and the flexibility, especially the increased flexibility that we've seen over the last 2 years with COVID and doing more remote work and a focus on this hybrid work environment, that because of the roles that I play within the teams, I can do them from a remote place, both inside and outside of business hours. And it provides a lot of flexibility there. And also, when we talked about resources, it removes the pressure for me to have those acquisition fees or those different things. So one of the things I talk a lot with individuals is like, I want individuals to invest in deals that make sense for them. And I think the deals that I offer make sense for them, but ultimately it's their choice. I don't need them to, I want them to. And I think that's an important position to come from, and being able to play all those different roles.
Tim or Winston, let me repeat the question just in case. Have you ever played a different role within different teams?
Yes. I was taken out of my comfort zone. I'm hands-on. I love to be the boots on the ground. I like to take part in the capex management, but for this one deal, it was more so they needed me more on the asset management side of the coin than anything else, and I felt like I was on punishment because it wasn't. That's even though I do handle asset management, it's not where I really want to be. I prefer being, going from property to property and handling what I have to handle outdoors rather than being in the office. To each his own, but it just, but it was great because it gave me the opportunity to understand what they go through on a day-to-day basis. So I was fine. Eventually, it just took me out of my comfort zone, but now, I have a better view on what it takes for an asset manager, and it was definitely a learning experience. So yeah, if I still had it my way, I prefer being that boots on the ground guy, handling capex. But I'm able now to juggle multiple tasks, in a group. So it's cool. It worked out fine.
Yeah, Ray, and I would just say, just like the rest of the group, we, like Winston said, we have to go outside of our comfort zone sometimes, and we also have to encourage our teammates to go outside their comfort zone. That way, they can grow and back us up when needed in those respective positions. Underwriting, can I do it? Yes. Do I like doing it? Absolutely not. I can think of nothing worse than being knee deep in Excel. And I'd much rather, be the person on those asset management meetings, ensuring that our business plan is being implemented, within time, within budget, etc. Have I done other stuff too that's a little more boots on the ground? Like, yes, I've dealt with the city and, tried to get, permissions, certifications, things done with them. And dealing probably with any city is a miserable experience that just is slow as you could possibly imagine. But those are the kind of things that need to get done, right? And it's not always going to be on the property manager to do that. It's not always going to be on a construction manager to do that. Sometimes we have to step in and take care of that not so fun stuff too.
Thanks, Tim. Any more questions from the audience? All right. Well, I think it is late. It is a little bit later. What time is it here? We went. It's a good time. It's almost 2 hours. It's been productive. We will post this so that everyone that maybe didn't get a chance to stay the whole time, although we still got a good group in here, I can see. But if somebody had to leave or somebody couldn't make it, I get a lot of those. There we'll be able to capture this on YouTube as well. So we'll get that on there. I think the biggest thing to understand on this is that not every syndication is the same. Not every team is the same. Figure out what it is that you want to do, where it is that you want to invest, and then spend the time to learn a little bit more about who you're investing with. Because your money will be tied up for a bit. Chances are, if the markets are, continue the way they are, that we're going to continue to do well. But, certain teams just are able to, even in not optimal environments, are able to find those deals and continue to deliver. And it has to do with that organization. It all boils down to that. Assuming the deals are to be found, good organizations will always excel, and that syndications are no exception to that. So I think I'm going to leave it there unless there's anything else from our audience, our panel. Thank everyone that participated, and I want you to continue to get into this business. This is one of the best ways to grow your wealth. Whether you have a W-2 job and you don't want to pay attention, but you want to receive distributions and have some diversification within real estate, or whether you want to be an active investor It's just one of the best ways right now, because it does allow us to get into these bigger assets that we couldn't do by ourselves. Go team. And remember, invest where it makes sense.